Hello, my name is Anterio, and I'm the Chief Amazement Officer of Credit Honor, which is a credit builder consulting and financial services company dedicated to helping individuals, families, and businesses protect their health, wealth, and legacy. And today I have a presentation talking about Debt to Wealth program by our company, Credit Honor. I'm going to go into detail on the presentation. Definitely really look into the concepts, and I'll work to do my best to help you to understand how money works using this system. So I have two questions for you. Are you 100% sure you're going to have a great retirement, or do you have some doubt? And what if I can show you how to get out of debt in less than 9 years, including your mortgage, student loan, anything you finance, without spending any additional money? What would that do for you? Right? Most people want to have a productive life where they retire financially and comfortable, but with enough free time to do their things that's really important to them. The problem is very few accomplish it, and even worse, unless more people learn how to manage their money better, very few would ever accomplish this. Would you agree with that? Right? You can write your comments in the box on the right. So we look at the average American household, right? The average American household pays about 34% in interest that they earn in a lifetime out. They pay 34% of the money that they earn in a lifetime out to interest. That interest goes to cars, credit cards, their college education, mortgages, pretty much all of the types of things that we finance, interest is going out. And then we pay taxes. About 40 cents on every dollar the average American earns goes out to taxes. I'm talking about everything from income tax to gas tax, water tax, sales tax, etc. We may have an air tax coming soon. I hope not, because I'm gonna hold my breath if we do. So that leaves about 23% of our money left to live on. This is what we call our lifestyle money. That's what we have to pay everything else with, like our gas, car, insurance, any clothes, definitely food. Now, most financial advisors, what they do is concentrate on that 3%, right? You know what they always told us? Hey, you've got to save more money, save more money. Guess what? I couldn't save more money, and most people can't. So lots of us are doing what we can. So looking at this chart, what we try to focus on is the 34% going to interest and 40% going to taxes. So our approach is we want to reduce that 34% going to interest and also reduce taxes. That would give us more lifestyle money and would also give us more to contribute towards savings using the Family Bank Debt to Wealth Money Management Program. All right. So we have about 7 steps. One is knowledge, improving cash flow, reducing debt, reducing taxes, minimizing risk, and the big picture. In step 7, I'll explain later. So we have step 1 here is knowledge. Knowledge becomes power only when you put it to use. We have knowledge about all sorts of things: sports, web design, cooking, cars, etc. But to retire, well, we really need to know the rules of money and how money works. And another thing, with knowledge, how many people you know that are very knowledgeable about what they know, but never really put their knowledge and applied it to certain things? We've all know, we got many people who are very smart and know a lot of things, but never really put that knowledge to work for them. We're going to do that today. So what if I can teach you how to reduce the volume of interest you are paying to lenders, get out of debt in 9 years or less, improve your cash flow, decrease taxes, save for college, and retire with tax-free income? Of these 6 listed here, what will be your personal top 3? You can write your comments in the right of the box. I'm going to give you a few seconds to answer. My top 3 at this time, at the previous time, would be to get out of debt in 9 years, improve cash flow, and retire with tax-free income. I'm using these strategies for myself, and I can retire in about 5 years from this exercise. So what is your top three? Just write it in the comments to the right. Next is we have this board game called Life. How many of you guys remember playing this game as youth? You know, back when, you know, video games wasn't so big and the television set was still not color or in color. If you had the color TV, then you was balling at that time. So the life of the average American. When I used to play this game back then, in the game of life, I always used to try to skate by the game board without picking up any kids along the way. So I'm sure you guys can understand the same thing, but it never really fell through. I always end up getting a full set of kids in the car and got 4 kids every time. I don't understand that, but the laws of how it works, I guess, is built for it. So we're going to start right here. If you can see where my mouse is, I'm circling the middle here. This is where the wound is. And we're going to start out on this journey, right? We're going to look at the average American. We're going to start at 2 years of age, 4 years of age, 6, 8, 10, 12, 14, 16, 18. I'm saying those years in succession because usually when we're growing up in our parents' household, we're not financially responsible for anything. So I'm going along this trail here. All right, so we reach 18 years of age. Here's where it gets crazy. We reach 18 years of age. I'm a high school student. My mom and dad is telling me, hey, you got to get out the house. You got to go to college. So we go to college and we get into debt. Now, most students are most likely not going to get scholarships, even if their grades are competitive at certain institutions. So let's say for this example, we didn't get a scholarship. Okay, we go to college, we get into debt. We know that debt is deferred, is building up interest as we're going along through school. We don't have to pay it back until we graduate. We get our first credit card and get into more debt. We may not understand the power of credit and how to use it. And then along our senior year in college, we get our first vehicle, right? We get our first car and we stunting on college campus, our junior and senior year, we get into more debt. And while we're in college, you know, our senior year, we may meet a significant other who we like, whether you're female or male, you meet a significant other, you guys court each other, you get into more debt, you start living together now in an apartment on campus. That's more debt because you have more expenses. And you probably reduce some expenses too because you're living together and your roommates. Now, along the way, you guys have a child together. And hypothetically, you have a child, you get into more debt. It's more expensive. And you realize, hey, this two-seater that I got is not going to hold up. It's not really family readily available. So what you do is trade this car in for a Swagger wagon up here. You get the Swagger van. It becomes more expensive. And you get into more debt. You realize that staying on college campus, you can't stay on college campus this long. It looks lame to some people. So you upgrade to that big house and you get into more debt. And then we retire and then we repeat this cycle over and over again. And then our kids grow up, they go to college, they get into debt. We're co-signing on their Parent Plus loans. We're co-signing maybe on their credit cards. We're co-signing maybe on their first car. And then they finish and do our same cycle. They retire. They get into more debt, going on vacations, traveling, upgrading their lifestyle, and then the end. That is the average American. Okay. Average household total assets at age 65. So here's a situation most people in America find themselves in. The average person is going to earn $2 million during their lifetime. At age 65, they will wind up with about $60,000 in assets, including the equity in their house. This is certainly not the American dream, having $2 million pass through their hands. The average person saves only about 3% of their $2 million. That's just $60,000. So there are a lot of people who are out there who have less than $60,000 for retirement. So if I'm a person that's reaching 65 and I retire and my lifestyle costs me about $5,000, $5,000 times 12 months, that's 60,000. It won't last me more than a year. All right. So step 2 is cash flow. When you track your money, you control it. So what we want to do is look for ways to save money and be more efficient. Experience has taught us that by utilizing a spending planner and tracking money, clients are able to find inefficient dollars that can make a powerful impact on their future. So along this program, we'll be using a spending planner at some point if interested. So we want to plan for the unexpected and the expected. We call this the 80-20 rule. The Family Bank Debt to Wealth program plans are strategically designed for real life. And we also know that 20% emergencies and emotional spending will happen along the way. Have you ever heard of the guy who went down to the car dealership to pick up a couple brochures and came home driving a new car? Well, how did that happen? It happened because most spending is emotional. Have you ever heard of a woman who came home with new clothes because they were on sale? Spending is emotional. When I buy myself an Oreo cookie shake on the way home because I've had a hard day, that's also emotional spending. I really didn't need that expense. The significance is that we don't realize spending is emotional. We won't allow for it, and that creates the problem. So let's plan for it, all right? So how banks leverage your cash. So you put money in the bank. So if you bank with Bank of America or Chase or any other bank, you put money in the bank. The bank gives you less than 1%. For every dollar that you put in, the bank times it by 7 by loaning it out to everyone else and charging them interest. All right, for every dollar you put in, they make about $7 to $10. So you make 1% and the bank makes 136% or more. So how would you like to be the bank? Use your dollar just like a bank, give every dollar 2 jobs, and create compounding interest for yourself. Step 3 is debt. Minimize debt to create additional wealth. So we have our typical family. This is Mark and Joyce. We changed their pictures for privacy reasons, of course, and we serviced these clients back in 2017 of August. All right, these are real situations. So here's their financial worksheet. Mark and Joyce, they are ages 37 and 35. Their desired retirement age is 65. They have 3 children, 3, 4, and 8. And their monthly income is just a bit over $7,000. Their desired retirement monthly income they want to receive after they become 65 is they want to have at least $5,000 coming in every month. IRA 401k, they have one set up with less than $100,000 into it. Their main areas of interest they want to have an increased retirement income, reduce debt, get spending under control, increase savings, college planning for the little ones, and they want to set up a will and trust so that when they are buried and dead one day, that they have a will and trust set up so that that trust fulfills its duty for their heirs, their children, right? And not the government stepping in to take all of the assets and divvy it out how they see fit. So that's what this will and trust is set up for. So here's their savings and investments. They have a Bank of America account. It's an emergency savings type of account. And they're making contributions of $25 a month. It already has $6,000 into it. And they make 1/4% interest per year. They also have a Fidelity account. It's a 401k tax-deferred account. It's have about $36,500, and they contribute about $300 a month, and it grows 5% interest per year. Okay. Here are the outstanding debts. They have a Visa interest rate 12%, balance $460. Their monthly minimum payment is $55. They have a medical and dental. They have a credit card. They have a furniture, auto and mortgage. And their total debt averages about 10%, with $180,000 for the balance, and their monthly payments are about $2,177. So Mark and Joyce's debt, they thought they were paying $180,000. When you factor in the interest payments that they're making on top of that balance, it came out the real debt is $380,000. The difference between the current balance and their real debt is that $199,000. The reason that we're paying so much more is because of the interest going out to all of those institutions. The Visa, the medical, the Discover card, the furniture, auto and home. Remember the 34% of interest we looked at earlier in the pie chart? Well, that's how much it adds up to in their life. So we prepared a report. For Mark and Joyce, and they were shocked at what they saw. Frankly, we find that most of the people we show this to are shocked when they see just how much money their interest adds up to. You mean to tell me that the interest is more than the actual balance of their payments? That's ridiculous. So here's their current retirement plan. Remember that 401k they had? They had $36,500 current retirement savings, right? They contribute $300 a month to it. It grows on average 5% annual interest. Of course, we know with 401ks, there's risk. Example, the 2008 crash. And a lot of people lost a lot of their money into their 401ks because they also own the stock market. So whatever the stock does, it's reflecting in the 401k. 25% income tax bracket. Let's hypothetically say that they're going to get hit with 25% tax bracket when they take it out at 65. And a retirement account at the end of savings year period. So they saved $300 for 30 years. They've accumulated before taxes $408,000. After tax, once Uncle Sam take his cut of that 25%, they're only left with $306,000. That's a $102,000 difference. What could you do with all of that money? What benefit could it do for you and your family had it not been taken out? So we're going to take a look at what Mark and Joyce were able to accomplish with your family bank, their own family bank. So this is what we helped them accomplish. We got them free from lenders in 7.8 years instead of 30. We saved them about $122,000 in interest. Remember that $2,177 a month they was paying to their debts? We got that freed up for retirement. And in savings in 30 years, instead of $306,000 with their 401k, we got them over $1 million. Now, I know you're looking at this and I'm like, how is that even possible? Well, I'm going to show you in the next few slides, so just stick with me. Of course, we understand that we do have stuff to buy, or they have stuff to buy. For instance, they might have to buy another car, maybe a boat or house during the next 30 years. What we're really trying to do with the idea of the Family Bank Debt to Wealth program is to show a better way of buying those same items, right? So the current plan, remember that $306,000 at their 401k, that was their retirement once they hit 65. Our plan, we got them over $1 million. Now, let's make sure we get the picture here. Mark and Joyce is living their life and doing okay. They've got a good income, but their debt service meant that they were going to be in debt for at least 30 years. Using our strategy, we were able to help them get out of debt in 7.8 years without spending one more penny and saving them $122,000 in interest. And if they kept with the program for the remaining 22 years, Mark and Joyce will have over $1 million in savings. Now, most people, when they see this, immediately make a decision to be like Mark and Joyce. It definitely includes you. Would that include you? It sure included me. So what does it cost not to do the Debt to Wealth program? So if we got them $1 million in retirement and there's $122,000 in interest, the cost not to do it would have been $820,000. They would have lost the opportunity of that money on this program. So we also have the Debt to Wealth program for businesses. There's also a business solution for them as well. So meet Joe. Joe is 50 years old, small business owner that does well on a day-to-day basis, but is usually hindered by one of the following problems. He has debt, he has cash flow problems, he has tax problems, as well as flexibility. So here's Joe's debts. He has an equipment, car, another equipment loan, a truck, construction loan, line of credit, personal residence. And here's his average interest. Average interest 4.82 with about $2.1 million balance. That's $26,000 a month going out to pay his debts, okay? So Joe's business will be in debt for about 27.8 years, paying over $650,000 in interest. That is insane, right? So that $26,000 going to debt every month. The total debt was $2.1 million. You tack in the interest, it's $2.7 million is going out of real money that he's working for, going out to pay his creditors. All right. So what if we can show you how to eliminate debt, increase cash flow, create flexibility, and decrease taxes for your business? So my business owners out there, this would be for you also. So here are the solutions we got for Joe by using our Family Bank Debt to Wealth program. Current debt plan payoff years, 27.8. We got them down to 6.4 years, literally almost 21 years. Interest saved, $270,000. In addition, Joe has now freed up over $26,000 a month. Well, that's $312,000 every year to improve cash flow and create other business opportunities. Business solutions. So put this in perspective. In the same time frame that it was going to take Joe's business to get out of debt, he would be debt-free and potentially have over $10 million in 28 years liquid. So here are some benefits for the businesses when using the Debt to Wealth program for their business. They have access, of course, to succession planning, equipment financing, exit strategy, tax savings to pay off debt, increase cash flow, definitely liquidity, flexible premiums, flexible loan repayment, finance business equipment, death benefit, policy cash value tax-free, less depreciation, which results in increasing business value. So if he wanted to sell his business, he could at a much higher price because of the value of him not having any more debts to his business. Step 4 is taxes. The less you pay, the more you keep. Every year, it seems there's a new tax law. Of course, we hope that when you sit down with your tax advisor or your financial planner every year, they probably go over those rules changes with you to pretty much keep you informed of what's happening and how you need to adapt. They probably have you on a path already to get out of debt. Is that correct? Maybe not. One of the things we do is to keep track of the changes that are going on and make sure that we are on top of those things so that we can advise the people that we are working with, that are working with us on their Debt to Wealth Family Bank. All right. So what do you think in the future? Do you think future tax rates are going to be lower, higher, or stay the same? Answer in the box on the right side. Yep. High, high, low. Okay. We got 1 low, 6 high. Okay, stay the same, stay the same. No, history is repeats itself. All right, we got 1, 2, 3, 4, 17 hires. Okay, another 18 higher. 19 highs, 2 lows. Okay, so most people agree that taxes will be higher in the future. All right, so if we think taxes are going to be higher in the future, is postponing taxes really a good idea? Of course not. So when should we start tax planning? Now. Absolutely. That's absolutely correct. So do you know how IRA works? IRA works at the end, individual retirement account. Do you know how it works? So let me show you something. I found out, let's say we put $5,000 per year in an IRA earning 10% interest. With the rule of 72, we know that those funds will double every 7 years. So a rule of 72 was created by Albert Einstein. He said it was one of the 8 wonders of the world. And the rule of 72 states that if you take the number 72, you divide it by the interest rate, the answer is the number of years it takes to double. So in this case, 72 divided by 10% is around 7.2 years, but we're going to use 7 for these representation purposes. Easier for numbers. So every 7 years, that money doubles. So what advantage do you get by utilizing an IRA? If you said a tax deduction, you're right. So at age 45, you will be able to deduct 1250, age 52. This deduction is 2,500 and so on. So we got the first year, we put 5,000 in. 7 years later, I'm 52 years of age now, it grows to 10,000. 7 years later, I'm 59 now, it doubles to 20,000 every 7 years. 7 years now, I'm 66, it doubles to 40,000. So that tax deduction that I talked about, we deduct that 25% from the 5,000. Let's say hypothetically we have a tax savings. Growth at 10%, same like the IRA. We're growing it outside of the IRA now. 1,250. 7 years later, it doubles to 2,500. Another 7 years, 5,000, and another 7 years, 10,000. Great, this looks good. We got 10,000, so they say. So by age 66, you save 10,000 in taxes, correct? Now, when you pull that money from the IRA at 66, at the 25% tax bracket, what do you owe? So it's 40,000 times that 25% tax bracket. Tax, we got to pay 10,000 on that money. So if I hypothetically save 10,000, but the IRS just took 10,000 from the account once I reach maturity age, where's the tax savings? Exactly. We never had any. We never had any to begin with. It's a myth. It is a myth. My point in showing this is that by reducing the tax liability, you can put more money in your pocket. Do you agree? Okay. So let's take a closer look. We're going to look at a $10,000 investment for 28 years at 7% interest, working with an average tax rate of 25%. This is what your account will be worth. You have 41,900 in taxable investment. You have 49,000 in tax deferred investment, and you have 66,000 in a tax-free investment. It's clear that knowing the different ways assets can be taxed and getting started, taking advantage of them early on in life is a really good way to make sure that your retirement is going to be what you want it to be when you get there. So of these three, which one are you choosing? You want tax, tax deferred, or tax free? Definitely, all day long. We always pick tax free. But many people are picking the tax and tax deferred. So I have a business proposal for you all. Yes, I have a business proposal. You're going to love it. You're going to love this business proposal. Okay, here we go. You front all the money. You take all the risk. You manage the business on a day-to-day basis. And in 30 years from now, I'll tell you how much you owe me. Now, hearing that, would you want to go into business with me? I know this sounds like a horrible, horrible business partnership, yet this is what people do every day, and when they start a qualified retirement plan with the government, this is what happens. So let's run it down. 401k, for example, you front all of the money in a 401k. God, you know, I'm glad that some employers do a matching program, which is good. They do matching, 3 to maybe 5%, maybe that's pushing it, but 3%. They do a match. Okay. You take all the risk. So if the stock market crash and the 401k is a part of that, you also take a hit. If you take money out of your 401k, you're going to get hit with a fee, as well as you're going to pay taxes on the same money, your money that you're borrowing from the government account. You manage the business on a day-to-day basis. So what that means, you got to work that job. You got to manage it. You got to be the one paying into it every paycheck. If you don't manage it on a day-to-day basis, meaning if you don't work, nothing gets contributed to it, right? 30 years from now, I'll tell you how much you owe me. This is Uncle Sam. This is the IRS. Hey, you reach 59 and a quarter or 59 and a half. I want my money. So remember, if we thought taxes are going to be higher within the next 30 years, once you reach that 59 and a half for that 401k, whatever that tax bracket is, maybe it's 40%, your retirement that you work hard for all those years is going to get hit. So imagine you putting in $100,000 or more into a 401k. You've built this nest egg. It didn't include interest for so many years. And when 30 years hit, they take their cut. The IRS takes its cut from your principal, the money that you work hard to put in, and the interest, the gains that you had on that account from you. That is not fun. That is not fun at all. So next, we're going to talk about step 5. That's risk. Don't lose a lifetime of work. All right. So what are your potential risks? Of course, there's taxes. We know that taxes is here, is there. We know it's the market. We all know that what goes up must come down. So it may look good now, but it's going to come down. It is controlled. Inflation. We all know that the stores that we used to shop at back then, they don't take the same amount of money like they used to. I used to go to the store and get a full cart of groceries for 20 bucks. Now I got to spend 80 bucks to get the same 20 bucks that I used to spend back then. Emergencies. We all know that emergencies may happen. We all are, not looking forward to emergencies, but they do happen. God forbids that you're disabled and you have disability issues. We may face potential lawsuits, potential fraud. Mainly with fraud is identity theft, outliving your money, and death, right? So those are some very unfortunate risks that we may face, right? Step 6 is the big picture. Know where you're going and how to get there. If I'm going to Florida or I'm going to Maine or I'm going to California, I'll take a different route to get there, right? So I have to know where I'm going in order to know what route to take. Well, it's important to take a look at the big picture when you're trying to get out of debt or when you're trying to save for retirement. You need to have a blueprint, a plan, a roadmap to know how you're going to do it. So what's your definition of retirement? All right, you answer that. And what age do you think you'd like to retire? Do you have a specific plan in place to accomplish that? You might remember that Mark and Joyce didn't have a plan in place and they couldn't tell when they were going to be out of debt. So of course, they also couldn't tell what their retirement was going to look like. It sure would be good to know all of those things though, wouldn't it? One of the ways we help is by addressing the 3 phases of retirement. So we look at the 3 phases of retirement, putting a plan in place. Much emphasis is out on the accumulation phase while ignoring the maximization of distribution and maximization. Our plans are designed to address all 3 of these phases. Most financial advisors only focus on accumulation. Hey, look at this return that we're going to get you on this account. Well, that may not be guaranteed. We want to look at actual things that are going to happen as realistic. We want to be able to maximize as much as we can into the family bank, into the policy. And we want you to be able to control that money while you're living and borrow from it at any time. We want to be able to do all 3 of those aspects for you with this program. So big picture plan benefits. Argue less about money. That's one of the benefits. Find wasted money, improve cash flow, dramatically increase your savings, get out of debt faster than you ever thought possible, learn how to prioritize your accounts, and retire with tax-favored income. So remember Mark and Joyce's before, where their real debt was $380,000. The difference between the current balance and their real debt was $199. Remember the interest in what they were paying. So we prepared a report to show Mark and Joyce, and they were shocked at what they saw. So frankly, we find that most of the people we show this to are shocked at what they see, just how much of their own interest adds up. So remember what we helped them accomplish. We got them free from lenders in 7.8 years. We saved them $122,000 in interest. We freed up to $2,177 a month for retirement. And in savings in the period of 30 years, we got them over $1 million. So let's show how we worked that. So now most people see this and immediately make a decision to be like Mark and Joyce. Would that include you? All right. So here's Mark and Joyce information. We serviced them again back in 2017. And here's where their redirected funds were. So this is this program is considered a whole life high cash value policy but this is specifically designed to help people get out of debt and build wealth at the same time. So let me explain. This will take definitely some time, and I want you to listen very carefully, take copious notes, as this is something very beautiful. This is the magic. This is where the magic happens regarding this. So, oh, I'm sorry. Let me skip back to the previous slide. Let me go back. So here's the redirectors that we found. Here's the redirected funds that we found for Mark and Joyce. It's 625 bucks. So let me tell you where we got these numbers to fund their family bank policy. So 625. Remember the savings account with Bank of America that they had, if they were contributing every month, that 25 bucks? Ooh, my writing is terrible with a mouse. The 25 bucks is this right here. It reflects that. Remember the $300 a month that they were saving to their 401k. 25 plus 300, 325. So you're probably thinking, like, where's the last $300? Well, the last $300 came from their debts. They were overpaying their debts by 300 bucks. So, for example, this Visa, for example, we know that when they came to us, their current balance was $460, but their monthly payment minimum was $55. If their monthly payment minimum was $55, they were overpaying by at least 100 bucks for this specific debt. So 100 minus 55 is 45 bucks extra that they're paying on top of that debt. So that's the overpayment of debts that I'm talking about. It was a total of 300 for all of the debts below. They were overpaying their debts. Why give the creditors more than what they're asking for? If you give them more back than what they're asking for, they're not going to give you any returns on that money that you're giving them. So you're overpaying them, and they're still charging you the same price, right? So that's where that $625 came from. We use this $625 for the premiums for their whole life high cash value insurance policy or their family bank. We're going to use their insurance policy just like the bank, and I'm going to explain to you how it works. So remember their numbers. If they would have did it themselves, it would have took them 30 years to get out of debt. The total debt was $180,000. The interest tacked onto it was $199,000, and the real debt is $380,000. So that total debt versus real debt, $180,000 and $380,000. This is the real debt. Man, it looks intimidating. So here's our plan. Here's how we got them out of debt in 7.8 years. So follow me for a second, because it can get confusing. I'm going to explain it as great as possible that I can to you. Okay, so the categories. Here's the number of years. Here's the last payment date that they're going to be making on that debt. The total payments, this represents the number of months. 2 months, 6 months, 11 months, 14 months, etc. The debt description, of course, we all know. The interest rate that they're paying on those debts. The balance at the time where they started the family bank. The monthly payment. The payoff and the roll-up. So I'll explain how this works. So we all know that their monthly premiums is 25 bucks a month. Times that by 12, it comes out to about $7,500 a year. Okay, that's great. We have the insurance company. We have our cash value. Two separate things, all right? So let's explain how we got them out of debt. So we're going to take this Visa. They've been paying 55 bucks for 2 months 55 times 2 months is $110. $110 minus 460 is about $359. Now, understand that there's some pennies and cents involved, so that's why it came out to $359. So 55 times 2 is $110 minus 460. It's $359. This is how much we have left to pay it off. Okay, perfect. We got $359. We built up enough cash value in our policy to take out a loan from the insurance company's account, their pockets, not our cash value. If we take from our cash value in the policy, then we take from the principal, and the money that's building in that, it reduces the compounding interest effect. So 625 times 12 months is $7,500. In this specific policy, every month that I'm making premiums into this policy, 40% of that money goes to keep the policy open. Okay? It goes to keep the policy open. That's the minimum required to keep the insurance policy open with the death benefit and the other benefits. And I'll go into the benefits later. The 60% of the money goes to cash value. So 60% of $625 per month goes to cash value. So 625 times 60% is $375. So every month, my premiums of 625, 60% of that, which is 375, goes into cash value. So if $375 is going into cash value, and I only needed, and I paid 2 months of paying $55, you know, keeping my debt payments every month. If I paid $55 for 2 months, and it brought me down here to $359. The $375 that I paid for 2 months times this by 2 months, and this comes out to $750 in cash value. So $750 in cash value is built up after 2 months of paying into the policy. I can use 95% of the money in the cash value. So 95% of that $750 is $712.50. This is how much I'm able to borrow as collateral from the insurance company from cash value, right? So I'm not taking from cash value, I'm taking from the insurance company's pockets, because they understand that if I take from my cash value personally, it reduces what it could grow for me. This cash value is growing a guaranteed 4% interest every year. Every year, this grows 4% interest plus dividends. All right, so $712.50 is what I can borrow. I only need $359. I borrow $359 to pay off this Visa. I paid off the Visa, and I freed up this $55 a month now. What do I do with it? I roll it up back to the insurance company to pay back this loan, this $359 loan, so I can use this money again for a future purchase. So I need this for the medical. So now you kind of have, you understand kind of how it works now. So now, literally 4 months later, on month 6, I have a medical bill. I've been paying $200 a month on this medical bill. 200 times 6 months of payments is $1,200. $1,200 minus $2,420 is $1,220. left to pay off. Remember, I'm contributing $625 a month. $625 for 6 months is $3,750 that I've accumulated. And I can borrow 95%. So 95% of that 3,750 is $3,562.50. But I only need $1,220. And remember, the freed up money that I freed up outside of the policy is going to pay back the loan. So it went back to pay back this $359. I can then 4 months later use this money again, plus the money I've already built into it, the premiums I'm paying every month into the policy. Now I can get this loan for $1,220. I get the loan for $1,220. I pay off the medical, and now I freed up this $200 a month, plus the $55 that I already have, for a total of $255. So now you kind of understand how it works. I know there's a lot of scribble scrabble, and it's a lot to learn, and that's what I'm here for. So the Discover, I've been paying $296 for 11 months. $296 times 11, it gives me my answer. The answer of that minus 4,236, I'm left with $1,419. I take out a loan from the insurance policy. I pay off the Discover. I free up the $296 plus the $255 I already have, for a total $255. I now have $551 now. I do the same thing. I pay this back extra fast. It only took me less than 3 months to pay this back. 551 times 3, it's over 1,500, about 1,600 or so. 1,419, this got paid back in 3 months. So now 14 months of paying $625. Of course, that's a lot of money that I'm building up now, cash value, and what I can use. I've been paying $237 for 14 months on this furniture. That $237 and that 14 months gives me my answer. The answer minus 5,988. I'm left with 3,715. I go to pay off the debt using the insurance policy collateral as a loan, the cash value collateral. I pay off the furniture. I free up the $237. And the $551 I already have freed up outside of the policy, it's now $788 I'm getting back every month freed up. And I do the same for the auto, $417. I've been paying for 20 months. It's about 2 years, almost 2 years. $13,000 was my balance after paying $417 for 20 months. I'm down to $6,316. I take out a loan from the insurance company. I pay off the auto. I free up the $417. I'm now down to $1,205. I'm saving $1,205 now. Now we get to the big one, the mortgage. This is a difference of 74 months. 20 plus 74 is 94. So 74 months. 74 months. All right. So now $972 I had monthly payments for my mortgage. I've been paying it for 94 months. 94 times 972, which gives me my answer. The answer for that, plus the money outside of the policy that I saved up, and the cash value, money outside of the policy, I've been saving $1,205 for 74 years, mind you. And now the $625 times 94 plus the $1,205 times 74, that money inside the policy cash value and the money outside the policy cash value, I can now borrow money inside and outside of the policy, the money that I'm saving up, to pay off this mortgage now. $136,000 is to pay it off. I now free up the $972 plus the $1,205 for a total of $2,177. This is the money that they have freed up now for retirement. This is how they were able to get their million. Yes, it is a lot. It is a very new concept, and I don't expect everyone to understand it at first, but that's what I'm here for. So now here's a comparison of the current Your Family Bank at 30 years. So when they did it with our method, we got them out of debt in 7.8 years. When they did it their way, they had 30 years to pay off their debts. The interest paid, we only had them pay $77,000 in interest using our method. If they did it their way, they would have paid $199,000. Liquidity, this is what they have liquid, over $1 million. So here's where they got the million. The million came from the cash value policy, the cash value in the policy, plus the money outside of the policy that they freed up, $2,177 for about 20 to 30 years saved up, plus the cash value in the policy, plus the dividends on the policy. With them being a policy owner with this company, they have dividends that they receive from the company for being a policy owner. All right. Savings and death benefit. They have $1.2 million to leave to their heirs. $1.2 million, part of it is death benefit, and the other part is the savings outside of the policy that they built up. So that's where that $1.2 million came from, if they were to die with the savings and death benefit. Okay. So here's their roadmap. Everybody will get this same roadmap. It will just be with their numbers. So once I get your numbers on a debt sheet, which I can email to you after this presentation, it will look similar to this, but just with your numbers, just like it. So here's their current situation. Remember, they were 30 years to pay off the debt, $199,000 in interest, of scheduled interest, doing what they are doing if they did it their way. Our way, hey, we say continue to make your monthly debt payments. The client will continue to make their monthly payments on their existing debts until the policy has enough cash value to pay off the debt. So they continue to make their regular payments so that they won't go into collections or default on any of their money, any of the creditors that they're paying. All we did was redirect the inefficient dollars to begin their own family bank. We pay off the debts with the policy cash value on specific dates. We create the dates once we get the numbers. It's automatically designed to get out of debt the fastest with using our system. We redirect the freed up money, monthly debt payments back to the policy. Once a debt has been paid off, the old payment now goes to replenish the cash value to pay other debts in the future. And here's the result: 7.8 years to debt freedom, as opposed to 30 years, $122,000 in interest saved versus paying $199,000 in interest. So the amount of total money that accumulated in savings and the total death benefit, note the policy cash value is already factored into the death benefit. So 30 years, you can potentially have $1 million in liquid and or a combined savings and death benefit amount of $1.2 million. Okay. So here's another look at it from a illustration standpoint. Any years highlighted in yellow is the years that they took out a loan. So for example, year one, he started at age 38. Remember, 625 times 12 is 7,500. 60% of that money goes into cash value from the premium. So you have access, remember, you have access to this cash value literally the first month. There's no waiting 5, 6 to 7, 10 years to access the cash value. You have access to this money literally the first month when you use the service, when you have the policy. Remember, this policy is specifically designed to help you get out of debt. No other product has this. There are many patents on this technology. You also have the death benefit. It increases. So loan from savings, of course, there's no loan from savings because we're still building up that savings. What we use as a loan as collateral from the cash value, we got this from the insurance company's pockets, not our cash value account, $2,998. End of the year loan balance, we only had left to pay back at the end of the year, $952. The adjusted CV, remember the 80-20 rule that I talked about earlier, where 80% was lifestyle and 20% was emergency and emotional? We do want to allow for purchases outside Let's say you have birthdays or Christmas, you do have 20% of that money that you can use for get-togethers and other expenditures that you may have. You do have access to this money. It is your money. You have access to this money. So it's just a combination of this. It's just split into two categories, 80% here and 20% here. Savings balance, of course, we're trying to get out of debt. We don't have anything saved yet because most of it is going to pay off the debts. Annual liquidity, we have about $3,302 annual liquid based on the difference here, which is what we have left at the end of the year because we have to pay back $952. It would be $4,430, but we took out the loan, and this is how much we have left to pay. And the $625 that's building up every month into the policy, of course, is creating the cash value. So year two, we took out a loan of $2,747 outside of the policy, plus the loan from cash value, and we only used $7,284 to pay off all of the debts for the second year, and we only had at the end of the year to pay back $111 left to pay back the loan to the insurance company. That's beautiful. So now, literally 1, 2, 3, 4, 5 years, we get to save all of this money. And on year 8, we have enough outside of the policy, that $90,000, the cash value inside the policy from the insurance company, we got $46,000 to pay off. Remember that $136,000 mortgage left that we have to pay. Once we paid that off, all we had left to pay back the loan was $40,000. Year 9, all we had left to pay back into the loan was $14,000. Now year 10, we have no more debts. It is just strictly cash flow. The $2,177 Mark and Joyce was spending out to the debts. Everything is now freed up. There is no more money that they have to pay. It is free money now. They have everything freed up. So down here, year 28, they're at 65. They have no more premiums to pay into the policy. They remember their desired retirement age is 65. So they're retired. They have $318,000 in their cash value, plus money outside of the policy, over $500,000, almost $600,000. And what's not shown here is the dividends as well. Of course, we don't know what the dividends are because it changes every year. The insurance company makes money and divvies it out to all of its policy owners. So that's what will give us the $1 million in cash value and savings outside of the policy. Here's what the heirs are get in death benefit if they die, plus the cash value, the savings outside of the policy that would give them that $1.2 million. Again, if we factored the dividends, it would be a little bit more. So the $318,000, they can do whatever they want with this. They can take out a loan at any time and pay themselves as long as they want. So now, mind you, let's say hypothetically, I'm sure this is a question that's probably on your mind. Hey, if they borrow this $318,000 and never paid it back, what happens? Two things happen. If they borrow from the policy and cashed it out, remember they can only borrow 95% of the cash value. So if they cash the policy out and surrender the policy, the insurance company would take what you owe them from the cash value, and whatever's left of the cash value goes to you. And because you're surrendering the contract, that money is taxable because you surrendered the contract. If you keep the policy open, it's tax-free cash value, cash growth. But they surrendered the policy, the insurance company takes their cut of what you owe them, and the rest goes to you. If they died and they owe this $318,000 as a loan to the insurance company, what they would do is take the difference of what you owe from the death benefit. So $568,000 minus the 318 is what's left that goes to the heirs. Well, you got money outside of the policy too, so that's up to $600,000. So the rest goes to your family. Remember, they had a will and trust set up. Here's another illustration, just looking at more years of them keeping the policy for as long as they like. Again, they have no more premiums to make, and the policy grows 4% interest plus dividends every year, so they don't have to touch any of this if they don't want to. They have money available. All this money is available to them per year, every year, to be spent on a new purchase. They can get a new car without having to pay anything on it. You know, you didn't get a cash, strictly freed up cash. They can just pay everything in cash if they would like to. They can take this $500,000 and invest it into a business and grow more money on themselves. They can take this money and put it into their business, charge their business interest on the money that they're paying to their business. The business pays them back, and the interest that they charge their business is now tax deductible. So they can get a tax deduction because the interest on the business that they tax their business with the interest, they can now get it as a tax write-off. So at year 77, $1.1 million outside of the savings saved, and over $500,000 in cash value. So here's another look at how it works from a visual standpoint. You have a checking account. You write a check or keep your normal monthly payments. You pay your debts, your car, mortgage, Visa, student loan, credit, any other loans that you have. All we do is take the overpayment of debts, the contributions from the qualified accounts, and the savings. We put that money into your family bank. The money grows, cash value grows annually every year. We use 95% of this money as collateral, and then we pay off the debts. Once the debt is paid, we roll over and pay back the loan and pay off another debt, and we finance future purchases. Here's the benefit of using your insurance policy like a bank. Of course, the benefit, use it like a bank. You have a living benefit. You have a death benefit. If you can't do 2 out of the 6 activities of daily living, eating, dressing yourself, walking, different ailments that you have, you can borrow from your death benefit to pay you directly. Have a retirement tax favor, and you have access to this money without any penalties. You do not get taxed on the money you borrow from the insurance company. Why would they tax you on a loan? That doesn't make sense. So this is all of the benefit of using this specific product with us. So let's review. We talked about knowledge, improving cash flow, reducing debt, reducing taxes, minimizing risk, and the big picture. Step 7 is your decision. A goal without a plan is just a wish. So the next step is to gather info in your data sheets. Identify, if you have a business, identify business personal needs. 2, identify ways to capitalize the bank. Analyze your data and run reports with your numbers. Schedule your big picture plan meeting with me, and begin underwriting process to see if you're qualified. Not everybody qualifies for this product, but we're going to look at your situation and make sure that we work to help you get qualified. There are many different strategies we can use. And that will conclude my program. I definitely thank you for your time. If you are able to have some free time, definitely contact me here below. If you would like to get started, all I would need is your debt sheets. And it is free for me to do this report for you. Once we move forward and you see that it is a good fit for you and your family and or your business, I would love to sit down with you with your numbers and get you squared away and make sure that your retirement and everything that you wish to accomplish is set in stone and working for you. My name is Anterio Jackson. I am the Chief Amazement Officer at Credit Honor. My slogan is truth, trust, transparency. We tell the truth, we gain your trust, and we're very transparent about everything we do with you in business. Thank you so much, and I enjoy this time, and you have a great day.